I know you tweeted this morning about earnings revisions peaking, where we're no longer getting upward revisions to earnings estimates. I've seen a couple different takes on it. J.P. Morgan looked historically and argued that equities don't really historically underperform as that revision rate tops out. What do you think?
Well, it does tend to usher in a bit more volatility, clearly, it's what we've been seeing. But I think the more important takeaway from that rolling over in earnings revisions is that it highlights the benefit in terms of outperformance of finding companies that have rising earnings revisions. In fact, as a factor, that has been the dominant performer, and I think will continue to be the dominant performer. And we've been saying, I know we've spoken about, Carl, that I think you want to be a bit more factor focused than sector focused or style box focused. And the beauty of a earnings revision factor is it's almost a hybrid growth and value factor, because you get that growth component by finding companies that have rising earnings revisions in an environment where in the aggregate they're going down. And of course, if you have rising earnings revisions, it means your forward PE is coming down because of the boost from the denominator. So that, I think, is the takeaway more specifically, versus some sign that the market is facing impending doom, which, to your point, it's not based on that measure.
Yeah, Lizanne, it's Morgan. I mean, you've been tweeting out some pretty incredible charts and data around all the supply chain bottlenecks that we've been seeing for weeks now. As we do have this broader conversation about earnings and peak earnings and how earnings continue to grow as we go into 2022 and where investors should be positioned, how long, I mean, based on some of that data that you are going through and sharing, how long could this potentially stretch on? How big of a risk could it continue to be?
I think it's going to vary depending on what service or good or product you're talking about. We know that there's been a ramping up of production facilities for semiconductors, but that's not something that turns around overnight. And there are estimates that are pushing that out further, either into next year or even the following year. Then you're already seeing some freeing up in terms of supplier delivery times, depending on what the mismatch is between demand and supply. So I don't think that there's some moment in time where we're going to look and say, okay, these supply chain bottlenecks are starting to ease. I think it is going to vary quite significantly. We do know that the base effects problem associated with the initial spikes in CPI and PPI are largely in the rearview mirror. But the improvement to the supply chain, we're maybe at the beginning part of that, but for certain production operations, that is going to be a long time coming.
So I guess just to dig into all of this a little bit more, I know one of the other things you've noted is this correlation between bond yields and stock prices. I mean, as we do see this debate around inflation continue to rage, you see the Fed signaling that it's going to start to move forward on pulling back some of its monthly bond buying. Where do you see rates going, and is there a point at which that correlation changes or inverts?
So the correlation between bond yields and stock prices has been positive for much of the past 20 years. Just about a month ago, it dipped back into negative territory. It now popped back up into positive territory. But if you look, and I put it on Twitter, I think this morning, a long-term look back to the mid-'60s, you had a very different regime from the mid-'60s to the mid to late 1990s, where for the most part, that correlation was negative consistently. And that was because we were more in an inflationary regime, that the economy was more subject to supply shocks. The 20 years leading into this year was the opposite. We were more in a disinflationary or deflationary regime and an economy that was more susceptible to demand shocks. And in that kind of environment, bond yields and stock prices move together, because the rise in yields in a more deflationary environment is more a signal of stronger growth, not an inflation problem, ergo good for the stock market. I think that's an important metric to keep an eye on, because if we move into a sustainable period of a negative correlation, I think that would be indicative of a bit of a regime shift. You know, the rub with Fed policy, of course, is that neither tapering nor rate hikes is the elixir for what ails global supply chains, and they know that. The rub would be if they have to come in to really squash demand in order to shorten the time frame to get supply to catch up. So I'm not saying that's a base case, but that certainly is a potential risk.
Shepard Smith here. Thanks for watching CNBC. on YouTube.